Hello and welcome to our webinar. My name is Joe Militello, and today we're going to be talking to you about building a private bank, creating a path to systematic riches. And before we get started, I just want to go ahead and tell you a little bit about myself. I am the owner of the financial services company Infinite Wealth, and I'm also the author of Know Your Financial Freedom. And that is a guide to systematic and guaranteed wealth creation. And today, that's what we're going to talk to you about. We've got a strategy to help you create your own finance company. And we're going to share that strategy with you today. And just so everyone knows, I know people are working and you might even be at the office right now. We're going to push through this in about 25, 30 minutes. So it's not going to be a long presentation, but some very valuable information here that you're definitely not going to want to miss. And on a personal note, before I get started with the webinar, I just want to let everyone know that I do have my own private bank. I've created mine some years ago. I utilize it and I maximize it as much as I possibly can. It is a strong strategy, something I think every American family needs to have in their corner when it comes down to protection and creating wealth. Now, I've provided that for myself, as I mentioned, many years ago, and I even use it for investments. And we're going to talk about that today, too. I use it for real estate investments. I do quite a bit of real estate investing as well on the side. So I'm going to teach everybody how to do that today. And one of the things that I really appreciate about what I do today is helping people. I love educating people and showing them that there is another way. Instead of all the traditional methods that we kind of get cornered with or are basically conditioned with, if you will, from the time that we've earned our first dollar, we're always pushed into where to invest your money and go to the bank and borrow from them, and so on and so forth. And today we're going to debunk a few of those common myths out there, and we're going to teach you some really positive strategies. So going into the webinar, I want to let you know that this account is a properly designed account, and we utilize banking principles and the volume and velocity of money. And we're going to teach you how to actually volumize and velocitize your capital to maximize the growth on the money. But in addition to that, these accounts are much more than just a private bank. These kind of double as a private finance company and an investment account. We use them for retirement strategy and also for an income generating account. These accounts can be used to supplement income in your lifetime, or it could be used to set up your entire retirement income. And they're very powerful that way. And we're going to teach you exactly how to utilize the income on the reverse side of the actual banking itself once you learn the strategies. Plus, there's a lot more positive attributes to this account that's going to help you recapture your wealth. And that's what I call reversing the money flow. And I think that's where it gets a little bit interesting for folks when they start to learn how to do that and keep a lot more of the money that they work so hard to earn. The biggest reason we can utilize these accounts is the safety and predictability. Now, I know when people hear investment accounts, they think, well, nothing's guaranteed. How safe is it? Well, it is guaranteed. We do have safety, and that's exactly why we use these accounts. And the principal itself is protected. And we're going to get into all the attributes of that account as we go through the presentation, and that's just going to be in a few minutes here. But this type of account, what I like to help people do is use it in place of any qualified plan, okay? I don't care if you have an IRA, a 401k, a SEP, 403b, or anything of the like, any qualified plan, you can use this in place of that. And I say that because this is much more flexible. Not only is there guarantees on your money, but there's also access to your money. And that's an important thing, okay? And I don't want anybody to be offended if you are using a qualified plan. If you are right now and that's all you have access to, that's great. You have to have your money working for you in some capacity. I'm just letting you know there's better ways. We've got other avenues to take. We've got stronger strategies, something that's going to help you actually grow your money and protect it. Also, as I mentioned, liquidity. Okay, these accounts let you have access to your money. And think about this for a minute. If you have a 401k and you wanted to gain access to that money, and I'm sure you have, most of the clients that I've sat down with, and I've sat down with hundreds over the years, have always said, if I could access that money to either invest with or to pay off bills or something of that type, how much farther they would be ahead. Now think about that, folks. If you had maybe credit cards, and I'm not talking about your daily credit cards or your monthly, something you use for gas and groceries and pay off at the end of the month. But some clients that I've worked with, of course, have built up some credit card debt. What if you could actually reach into your 401k, take a chunk of money, 10,000, 20,000, and pay those credit cards off, and then pay yourself back? Okay, you reap the benefit of collecting the interest. Hey, some of those credit cards have a high interest rate, rather. You know, I've seen them as high as anywhere from 18 to 24%, and people are paying this on a monthly basis. That's a lot of money coming out of your pocket. And I can challenge everybody, including myself, on that same scenario. Okay, if you added up all the payments that you've made in your lifetime, anything that has to do with borrowing from the bank and paying back with interest, I don't care what it is, cars, credit cards, mortgages, anything like that, and you add all that up as opposed to what you have put away for your future in retirement, do those two numbers even come close? I know it didn't for me, and that's really one of the reasons why I started with this company. But in addition to the liquidity, with the access to your money, it also creates generational wealth. And that's something that can take care of your family and your estate. And that's a very powerful tool. And also wealth drains. We're going to teach you how to either stop or drastically reduce wealth drains in your life. And you might be asking yourself, okay, Joe, what's a wealth drain? Well, that's where your money is being taken from you when it's unknowingly and unnecessarily leaving your life. And that's something that I think most American people need to be educated on. I don't care if it's yourself or myself. I know I needed it when I first started it. And it's really an area of your life that you don't realize that it's stealing wealth from you. And I'm going to go into some of those wealth drains right now. I want to give you a little bit of education before we get into the actual strategy. And as you see on the screen, I've got what looks like a nest egg. Okay, this is what you and I and everyone else out there has been taught to do. We've been taught to build our future, to prepare for retirement. And when we start our working career, they teach us to take a little bit of our capital, our paychecks, and put it away in our nest egg and plan for the future. Well, that's what most of us do. That's what our goal is. We're out there trying to build that up. The problem is, once those wealth drains come in, they start to drastically reduce that nest egg. And the four most common that you and I and everyone else out there faces are taxes, market losses, interest and fees to the bank. That's what we're talking about today, right? And depreciation. Think about all the depreciating assets in your life. I don't care if it's a car, a credit card. A car, of course, is going to be, the big one. The car, everybody has a car payment or has had a car payment in their lifetime if you don't have one right now. And you borrow from the bank, you pay the bank back the payments plus interest, and the car depreciates. And it could be on business equipment. It could be on any type of a boat, anything, any kind of an asset that depreciates. That's a wealth stealer. Okay, we're going to teach you how to actually make money on depreciating assets. Now, the column of wealth drains gets a little deeper. That's going to be different for most people. We all suffer the four main wealth drains, but individually we can suffer other wealth drains. And I've got a few more examples, one being longevity. A big worry in this country is outliving their money. Okay, we're going to teach you how to make sure you've got an income for life. How about loss of a spouse? You know, this is sort of a touchy area sometimes, but whether you're still in your working life or in retirement, people don't properly prepare for a loss of spouse because that can drastically affect the income in a household. Okay, so we need to really address that too. Terminal illness. If someone needed long-term care, again, an area that's not really taken care of or prepared for. And I've seen tons of clients over the years that were affected by that. And I've seen estates get cleaned out because they weren't properly prepared for maybe some long-term care expenses. And again, this list can go on, but you're getting the point, okay? You can add those into your own life or come up with some of your own, but those wealth drains start to drastically reduce that nest egg that we've worked so hard to build up, okay? We're going to show you how to reduce these wealth drains. Our goal is to stop them or reduce them as much as we possibly can and teach you how to maximize that nest egg, okay, to keep more of that hard-earned money, okay? Another area that I wanted to address with you really quick is an average rate of return. And I throw this one in there because you and I and everyone else out there has been taught or conditioned to chase a rate of return. And I hear it all the time. I sit down with new clients, and then one of the first things out of their mouth is, well, what's the rate of return? And that's not really the question you should be asking. You really should be asking, how safe is my money, and is it going to be there when I need it? Okay, average rate of return does not add up to real dollars and cents. And here's exactly what I mean by that. If you're looking at the screen, you can see a quick example of a $100,000 account value. And we're just going to run through this real quick. Now, these percentages are a little drastic, but it's for the ease of understanding of the illustration, okay? You can see year one, as it increases by 100% from a $100,000 account value. Of course, at the end of the year, you'd have $200,000. But at the end of year two, it's going to 50% loss. So if you suffer a 50% loss, you're back down to your original $100,000. Now, this is going to go through and it's going to repeat itself, okay? Year three, it's up another 100%. And then at the end of year four, you're back down 50. Well, if you're back down 50%, you're right back to your original $100,000. But the average rate of return on that is 25%. Folks, if you add up all your gains and you subtract your losses and divide by 4, that's a 25% average rate of return. But how does that add up when you still have the same amount? If you still have that original $100,000 account value? See, average rates of returns are not real money. And the reality of the situation is you're probably going to have less than that $100,000 because there's going to be fees that you pay to whoever's managing those accounts. Okay, it's not real money. So getting into the strategy itself, you and I and everyone else out there has been taught how to handle our money from the beginning, okay? And it's what I call a broken business model. Now you can see the white dot up here represents your income coming into your life, and the dollar sign is the income that has come into your life. And the first thing that we're taught to do is put a little bit of money away for our future, right? Let's put our 10% of our income in our retirement fund. And for a lot of people, it's a 401k, or it could be a 403b or an IRA, or some people even have money invested directly into the stocks. Although they are all invested through the market, it could be mutual funds or money market accounts. One way or another, they're all subject to loss, okay? And that's what we're here to try to avoid. But the problem that we face trying to put away that 10% is this. You're looking at paying for cars, mortgages, credit cards, student loans, business equipment. Anything you borrow money from the bank and pay back with interest is a wealth stealer, okay? And on average, statistically, you're looking at about a 35% of your income leaves your life in the form of payments. Well, folks, I can tell you from experience, I sit down with many, many clients, and I see a lot of them at 45, even 50% of that money is leaving your life, okay? Now, who's getting rich off of that business model? Is it you or the banks? It's definitely the banks. We're going to teach you how to change that. What if you can reverse the money flow? Okay, what if that money was coming back into your life? Let's look at this graph. The small dollar signs, the income coming into your life. Now, what if instead of making that car payment to the bank, you were making that car payment back to your private finance company? Or what about the investment, the 10% in the investment? What about going into that investment account? Remember I said it doubles as a retirement account as well. Any kind of a payment that you have, student loan, credit card, business loans, anything like that. What if you were able to recapture some of those payments going out in your life? Okay, how much more wealth would you have? My guess is going to be a heck of a lot more. Now, these guaranteed accounts are what we call a 770 account, okay? And they've been utilized for generations. It's a guaranteed account that has tax favorable attributes. The principal is guaranteed from loss, and that's a contractual guarantee, by the way, folks. Your money can never go backwards, okay? It's been that way for a long, long time. I've got my own, and I've never lost a penny. It keeps growing. Your money is always going to increase, and that's something we're going to definitely talk about, the growth of your money. Growth and dividends inside the account grow tax-free. This is a huge attribute to this account, tax-free growth. And we're also going to talk about tax-free income for life, okay? We talked about generational wealth. That's also tax-free, and I'm going to show you exactly how that works. Income's tax-free, and the cash inside the account creates a high cash value by driving it as your private finance company. There's guaranteed growth, and you're going to have increase in capital from using it as your own private bank. Something that most of America really needs to sit down and address. Using the volume and velocity of money in these properly designed accounts is what maximizes the growth, as we just talked about. And volume and velocity of the money is the speed of money. And let me give you a little example of that. I just want to kind of slow it down for a minute and give everybody a better understanding. I know you've probably heard of the term. It's used all the time by the financial experts, the so-called gurus that are advising Wall Street and the government and whatnot. And they talk about the velocity of economy and the money through economy. And it kind of works like this. Let's use that same $100,000 example. Let's say you had $100,000, you put it in the bank account, and we all know the bank takes our money and they lend our money out, right? Well, this is how they make money. But traditionally, the banks make a heck of a lot more money than we assume they do. They lead us to believe that they're making money between the interest rates that they get to charge when they're lending out that money. And that's not the facts. The facts are they typically make triple-digit rates of return, on average of about 112 to 116% per year. And the reason is this, because of the velocity of money. They velocitize the money and they volumize the profits. And the velocity is this. They take that $100,000. Let's assume that they loan out $25,000 loans. Doesn't matter what it's for. It just gets loaned out. So that'd be 4 loans for that $100,000. Well, immediately they start getting payments back, right? Well, within the next few months, 4 to 5 months, they're going to have enough money in there to loan out another $25,000. So they're not going to wait to get the whole $100,000 back. They're going to loan it out again. So now you've got 5 loans out there at $25,000 each. Now you've got 5 loans being paid back, so you're growing capital even quicker. Again, another $25,000 gets lent out before the end of the year. That's 6 times in a year. That's $100,000 being leveraged 6 different times. That is the volume and velocity of money. That's how the banks make real cash. That's how they make real wealth, okay? And we're going to teach you those same principles. And we're going to teach you how to do that just by self-financing, whether it's for your personal or business. And again, create that tax-free generational wealth. These accounts, a 770 account is a properly designed whole life insurance contract, okay? They've been in existence for generations, and they've been utilized by banks, large corporations, and even famous family dynasties. Folks, they've been using them for generations to create tax-free wealth. And there's hundreds of examples out there. And you know what? You don't have to take my word for any of this. This information's out there. Anybody can do the research, and anybody can get this information. And as I said at the start of this presentation, how I like to teach and educate people, well, you know what? You got to get out there and you got to teach you got to educate yourself. Okay, you got to get out there and you got to get the understanding, because if you don't do it, no one else is going to do it for you. And I like to be able to open people's eyes. This is, you know what we're doing today is we're getting people's thought process changed, okay? You and I and everyone else out there has been conditioned to think a certain way. It takes a little bit for us to open our eyes and see that there's other ways out there, better ways, with safety and predictability to grow our money and protect it, okay? Now I want to get into how the banks actually, or how much they're actually investing in a high cash value life insurance account. You know, this information, before I started my financial services company many years ago, I wasn't aware of this either, okay? But again, information that you can get out there. Bank of America, who's now the biggest in the country, right? As of 2013, $17 billion in high cash value life insurance. JP Morgan Chase, $12 billion. Wells Fargo, $7 billion. And the list goes on and on. In total, there's over 4,000 banks that use this strategy of investing in high cash value life insurance. And again, folks, information out there that you can learn all on your own. Now, I want to give you a quick example of how the contract works itself. Okay, people hear insurance and they think, oh God, he's selling insurance. No, that's not what we're doing. And forget all the so-called experts out there that teach you buy term and invest the rest. Well, all you're doing is buying insurance, and that's not what we're doing here. We're creating a vehicle with an insurance contract to drive as a bank and a private retirement account that creates tax-free wealth. You got to remember that. And it kind of works like this. If you see, this is an example. Let's just say this rectangle is an example of a life insurance contract. The white portion on top is pure insurance, and the blue, of course, is your cash value. Now, the way it works is you take some capital. Doesn't matter the amount. It could be a large amount. It can be a small amount. You can start your bank any way that you want. Okay, whatever you've got access to or have the ability to start it with. But the concept is you put some cash in, and it has to have, the only restriction is it has to have a corresponding amount of insurance. So whatever cash amount you have in there has to have that corresponding amount of insurance. Okay, so when you start this account, you're going to treat it just like you would any other investment account. Think of it as a 401k. How you contribute to it every year, you contribute to this account as well. You're going to keep putting your money in there year after year. And what it's going to look like is this. The growth on this account is linear. Remember we talked about average rate of return? That's not what this is. We do not have an average rate of return. This is guaranteed compounded growth year after year. Okay, so the green portion you're looking at right now, that's all profit. The blue portion is money that you contributed to your private bank or your retirement account. The green portion is nothing but profit, pure profit, and that's going to grow just like this, linearly every single year for as long as you contribute to your account. And the benefits that we have with these types of accounts is, I call them a hybrid type of a policy, because I can structure these to grow not only the cash, but also the death benefit. Now, it is an insurance contract, so it has the benefit of having a death benefit. Okay, that probably sounded funny, right? Benefit of a death benefit, I know. But let's look at the actual growth of the death benefit. As your cash value grows, so does the death benefit. Remember, it's got to be corresponding. So the more money that goes into the account, the higher the death benefit grows every single year. So this is contractually guaranteed growth on the cash side and on the death benefit side for your entire life. Remember, term is only for a period. That's a just in case something happens to me. That's not an investment vehicle. We're taking a properly designed account. Now remember those two words as well, properly designed, to create our own private finance company. And it works as a retirement account and a bank. Now I want to go over all these attributes that we talked about in the beginning, okay? First of all, no risk of loss to your principal. Contractually guaranteed, cannot lose a penny of your money. Secondly, it's contractually guaranteed growth. We just saw that. It's going to increase year after year. Compounded growth is interest upon interest. All your growth and your dividends are tax-free. Everything inside that account grow tax-free. It's one of the only accounts left out there that has this positive attribute. And we're going to teach you how to build tax-free income for the rest of your life with that account. The money is accessible anytime, for any reason, without any restriction. This is one of the reasons why we can create our own private finance company. Borrow for ourselves, go buy a car, pay ourselves back, collect the interest. Another positive thing that I love about these accounts is it has a layer of asset protection. These are lawsuit, judgment, and creditor proof, okay? You cannot touch these accounts for any reason. Now, I've never been sued, okay, knock on wood. And I'm sure most of you haven't either, but anything can happen in life. And, a standard investment account can actually be liquidated. But the law says, under the law, Michigan state law, and this is 48 states in our union, cannot be touched. Lawsuit, judgment, and creditor proof. Okay, we're safe from that. So it's definitely a layer of asset protection. And I love that part of it, especially me owning my own company. You have the ability to recapture principal and interest tax-free inside the account. You have easy access to the capital for the rest of your life without worrying about going to the bank and borrowing money. And that's literally a phone call away. 48 hours, it's right in your bank account. You have total control of what you use your money for, whether it's business or investments. You have the ability to put large sums of money into your account, unlike qualified plans. Qualified plans have those restrictions. Okay, they call them qualified because the government qualifies them. Another thing I don't like about that is they can change those qualifications at any time. Folks, it takes a stroke of a pen, and guess what? They're changing the rules again, and they seem to be doing that quite a bit lately. Now, the benefits that I'm looking at, the tax-free benefits that we talked about, is going to be even more of a benefit come the near future, because you and I and everyone else out there knows that taxes are going to increase. They're not going to go down. And the more money that we try to make or have the ability to make, the more taxation that we're going to suffer. And if it's in a vehicle that can actually create tax-free growth and have that tax-free income for life, there's nothing better than that. Plus, if you do take out loans, you can loan against this. You choose all the repayment terms. You can pay back once a year. You can pay back biannually rather. You can pay back quarterly if you want. You have the discretion to do exactly what you want with this account. Also has guaranteed insurability for life. Now, this is something that's very huge because term policies don't have guaranteed insurability for life. That's only for a period, whether it's 10 years, 20 years. And once that's up, talk to somebody that's had a term policy that wanted to continue it, but as they got up in years, all of a sudden their premium started to increase. See, it doesn't last forever. And all of a sudden it becomes unaffordable because it turns into thousands and thousands of dollars a year just for that policy, something you're going to want to avoid. This will guarantee insurability for life. And as I mentioned, I use this for real estate, okay? I like to invest in real estate on the side. And anytime that I do that, I go right to my bank and I take the money out, borrow for myself, and I go buy my real estate investments. You can combine this type of an investment account with any other investment. You can use it to self-finance anything, okay? And we're here to teach you to do that. Folks, anybody can set this type of account up. It's very simple. Today, we're just giving you the overview of all the major attributes and the benefits of this type of account, okay? Anyone can accomplish this. We're here to help you do that. And you can contact us at any time, of course, by phone. Just call us at the office. Now, I know we're going live right now. If anybody's got any questions afterward, just call in or even shoot us an email. We'll respond to you right away. We'll make sure we get back to everybody today before the end of the day for sure. But, we're here. We're available. You can send us an email right now if you'd like. Phone number is 586-200-1033 or by email, which is info@infinitewealthinc. That's inc.com. info@infinitewealthinc.com. Folks, again, take a step forward and talk with us. Let us show you how this is going to benefit you in your life. If you've got questions, if you already have qualified plans or investments, and you're wondering how you can incorporate this or use this instead of, whatever your thoughts are right now, give us a call. Get in contact with us. We'll help you with all those questions and give you some honest answers. Thanks for joining, everybody. Have a great afternoon.